Okay, cool. Yeah, we got definitely good turnout. So thanks everyone for joining. Really excited to share updates on our new fund to fund program. Excited to see some familiar faces here. So as a reminder, or I'll just reiterate for those that are just joining, we will make this as interactive as possible. So feel free to ask questions in the chat or through the Q&A feature, as well as raise your hand if you want to ask a question live by unmuting yourself. So yeah, feel free to make this as interactive as possible. And then we also will have time at the end for dedicated Q&A. So if you don't get your question answered during the presentation, we'll definitely have time to chat afterwards. And then, as always, Craig will be available after this to circle up with you one-on-one for a recap or a more in-depth conversation about working with us on an upcoming opportunity in a fund-to-fund capacity. And also reach out to Craig. Craig, just pop your details into the chat. Reach out to Craig if you want to get your hands on the fund to fund doc that we'll be sharing today or any other documents that we'll be sharing and talking about today. So without further ado, I'll go ahead and share my screen and get started with the fund to fund program document. So before we go ahead and get started, I'll just give a quick introduction for those that are less familiar with us. Hey, everybody. My name is Rob Beardsley. I'm the founder of Lone Star Capital. With me today is Craig McGrother, our Director of Business Development. We're really excited to be talking with you guys today about our new fund-to-fund program. So, uh, real quick, just to finish off the background, as a reminder, Lone Star Capital, we're based in New York, but we're focused exclusively on Texas workforce housing, value add multifamily. We have acquired over 500 million in property down in Texas over the last 5 years. And we have property management and construction management in-house, vertically integrated, based in Houston as well. And a major part of our business historically has been partnerships with many people on this call. So, and those partnerships have often looked like co-GPs and even fund to funds before we formalized this new fund to fund program. So fund to funds aren't necessarily a new thing, but the program and really creating a dedicated, structured system to facilitate these fund to funds is new. So we're really excited to be rolling this out. We've already rolled it out in a beta and have closed essentially a couple test fund to funds through this program, and it's gone extremely smoothly. So, as I mentioned, partnerships have and will continue to be the lifeblood of our business. And we don't see this necessarily as a new thing, but just an upgrading of the way that we've been partnering with folks before in fund to funds or co-GP partnerships.
And I just want to make a quick point as well. As Rob just very nicely said, we are structuring this to set this up as, similar economics, if not the same as you would get if you're a co-GP, as you would as a fund-to-fund manager. So there's no downside to basically raising in this capacity, if you will. This is just the latest and greatest that the business is kind of shifting to.
Yeah. And with that being said, you might ask, why? Why the shift? Why now? So, like Craig said, this is just the latest iteration. We noticed this trend a little bit less than a year ago in our industry really turn to fund to funds, and fund to funds have grown a ton in popularity. And I think the big part is definitely the SEC compliance factor. This is, from our understanding, the safest way to raise capital. So that's a big driver for many people. Another big driver is the greater control over your destiny as a fund manager rather than a co-GP partner. As a fund manager, you have greater control over your compensation, and we'll walk through the dynamics of how the economics flow and everything so you can better understand how you are more in control of your compensation as a fund to fund manager. You're in control of not just your compensation, but you're also more in control of your investors. So this is, for some people, a sensitive topic. For many others, frankly, it's not really a big deal. Most of our co-GP partners trust us and we trust them, and they're comfortable with sharing their investor information with us, knowing that we're not going to go around them to solicit their investors directly and things like that. However, with the fund of fund structure, that's you don't even have to worry about that at all because the investors, your investors invest directly into your special purpose vehicle, and then that SPV invests directly into our parent offering. And so we receive, as the lead sponsor, we receive one single check, and then that's from your fund. And so we actually don't see who the investors are of that underlying fund. So greater control uh, over your investors and your economics. And then of course the SEC compliance. So those are some of the things that we've seen in the industry or in the fund of funds space as to why this has grown so much in popularity. So if anyone has any other thoughts or feedback or what they've noticed in the industry as far as why fund of funds have grown in popularity, feel free to put it in the chat and we can highlight that as well. But that's just what we've seen, and we felt that rather than fight the trend, we would just take the lead actually. And because we were actually already, as mentioned, having a lot of fund to fund partners come to us and say, "Hey, I'd like to invest with you and partner. I actually raise money through a fund to fund. Can you accept that? Can you work with me?" And we say, "Sure, no problem." But now through this actual fund to fund program of ours, capital raising partners who don't have previous experience with forming a fund and managing a fund can come to us and we can provide this new turnkey solution. So that's just one of the many reasons to partner with us. But let me just quickly run through these bullets. Why partner with Lone Star Capital through a fund of funds? This goes for people who have never partnered with us or invested with us in the past, as well as our partners who have co-GP'd with us in the past. So obviously, first and foremost, in our humble opinion, Lone Star Capital is a best-in-class multifamily sponsor who you can trust with your reputation and your investor capital. The most important thing when you're talking about raising capital is trust and reputation. We all work really hard over many years to build reputation in the industry as well as trust with our investors. And we know that that can be taken away with one bad deal, right? You could have 20 good deals, but if you have one bad deal, it can do as much bad as the 20 good deals did good. So it's really important to be partnering with someone who you can trust to really be a good steward of your investor capital. And uh, anyway, that's my high horse for the day on Lone Star Capital. So the next bullet is the seamless process of forming the fund of fund and managing the fund of fund. And we've done this through a partnership with TribeVest. So many of you on the call, I'm sure, have heard of TribeVest. They have a great team. They built a great process. All this stuff at the end of the day is not rocket science. It's just a little bit more legal legwork. And thankfully, TribeVest has the in-house legal and systems in place to seamlessly handle these processes. So we're actually just talking with the TribeVest team today, and they're talking about how we're getting more organized and just doing a fantastic job of bringing in our fund-to-fund partners. And with all the right information put in place, they're able to hit the ground running and form the fund-to-fund legal entity, form the PPM, open the bank account. They can do that in 4 days. So you can be, if we share a deal with you that you want to commit to raising capital with us on, we we can through TribeVest have all your docs and bank account ready to go in essentially 5 days. So you can be ready to hit the ground running and not have any delays as far as your ability to raise capital. Because at the end of the day, we want to provide this as a system not to uh, be bulky or to weigh you down. We want this to be a kind of like your outsourced team, your outsourced accounting and legal team to help you underwrite, market, sell, and raise more capital with less effort. So,
And
mhm.
quick point to that as well. We're not forcing or needing anyone to exclusively work with TribeVest to raise money via the fund to fund structure with us. We know some people have their own legal teams in place or maybe use other vendors. That's totally fine. I just want to make that point. We're not exclusively working with them. We love working with them. We do recommend them, but there are a lot of great players in this space. Feel free to work with who you want to work with, but they've given us a very economically viable path to use them as a go-to potential solution.
Yep, absolutely. Yeah. So this is not a limitation or prescription. This is just our process, but people fund of fund managers are still able to invest and structure their fund however they like or with whomever they like. Let's answer some questions real quick before we move on. So we have an anonymous attendee who asked, should there be a better return to the fund of fund manager that if co-GPs? So like Craig said at the beginning, the goal with the fund of fund structure, well, it's multifaceted because again, like I said, as a fund of fund manager, you're in greater control over your own compensation. And I will get into specifics as to how. But of course, we provide a set structure for essentially the enhanced terms to the fund. So let me actually just take a step back and explain the general structure and how this all works. So we have a multifamily offering, and we have set terms that are available to the public based on a $50,000 minimum. However, a fund manager or co-GP partner can come to us and say, hey, I would like to participate in the deal through a fund to fund. And then we will provide a side letter to that fund to fund with enhanced economics. So what that means is a discounted acquisition fee and a superior waterfall with a higher preferred return and a lower promote. So that makes the fund to fund have a better, higher projected return. So then at the fund to fund level, because there's this higher projected return at the fund to fund level, the manager of the fund manager, can then take fees and promote at the fund to fund level entity. And then the net returns to the fund to fund investor can be effectively the same as if they were to have invested directly. Now, again, this is where the discretion of the fund manager comes in, because if you want to be a very nice fund to fund manager, you can not charge as much of fee and promote and actually give your underlying LPs a superior return than they could achieve if they were to invest directly. Or, not saying there's anything wrong with this either, or you could actually charge more fees and promote and actually give your LPs a lower return than if they were to invest directly. But of course, the fund manager will have greater compensation. So we've seen it both ways. I think there's a strong case to be made with having a strong relationship with your LPs, and your LPs are willing to pay a bit of a premium to go in on the deal with you, and you be the manager of their capital and of their deal rather than investing directly. But anyway, that is up to the discretion of the fund of fund manager. So, like I said, the way we kind of stage it and give the recommendation is such that the returns are comparable. But again, it's up to the manager's discretion. Real quick, good questions coming in here, by the way. Randy
Yeah,
asks,
and please keep them coming.
yeah, Randy asks, can you talk to the limitation on accepting non-accredited investors with this model? Okay, so we're absolutely not SEC attorneys, and we recommend everyone consulting their SEC attorney, and everyone has different risk tolerances. But our position is that a fund to fund that has so if a fund to fund is comprised of all accredited investors, then that fund is deemed accredited and will invest into the parent offering as an accredited investor. If the fund to fund is not comprised entirely of accredited investors, right? Let's say there's 1 or 10 unaccredited investors in the fund to fund, that fund, in our opinion, is still only going to take up one of the 35 sophisticated investor slots in the parent offering. That fund is deemed unaccredited, and that fund will invest as an unaccredited or sophisticated investor in the offering. That's our position. There's other groups that don't agree with that, and other SEC attorneys have different opinions. So consult yours, and if that's not something you're comfortable with, then don't do that. But
And
that's our position.
yeah, in addition to that as well, historically, Lone Star Capital has only done 506B offerings. Should we do a 506C, you'd be aware of it. And naturally, if you have a fund of fund that has 10 investors, of which one would be, non-accredited, he may not have a home in that specific deal, of course. But just as said, we've only done 506Bs. And for the foreseeable future, we will continue to do 506Bs. We perhaps might do a 506C or two this year, depending upon the opportunity, but just want to make that clear.
Yep, that's a good point. And uh, just as an interesting wrinkle, if the parent offering is a 506B, the fund to fund can still be a 506c or a 506b. It doesn't have to match. The offerings don't have to match. So you could have a 506c parent offering and you could choose to do a 506b fund to fund or vice versa. So that's just another interesting wrinkle to this whole situation. So Randy, hopefully that answers your question. We'll breeze through two more questions in the chat, and then Franklin actually, I believe, has his hand up. So we'll take a live question, and then we'll get rolling through some of the more nuts and bolts. But this is all honestly what the call is all about. These are the good questions that people want to know. So Franz asks, do you help with managing the back end process, like accounting, K1 distributions to investors, investor webinar, PDF, etc.? Yes. Okay. So fantastic. So TribeVest is essentially your outsourced accounting and legal team. And so they do handle the annual K1s for your fund to fund. They do handle the monthly distributions to your investors. So all that is taken care of. And that's really, that cannot be understated because that's a lot of work and that's a headache. And when you're talking about one of the selling points that we've given to our co-GP partners is that we would handle their distributions for their investors. We would handle the monthly reports and everything. And so that was a huge win because as a capital raiser, that can really bog you down if you have to then go back and make sure that you're handling K1s and distributions to your investors. We want to make your life easy. We want to incentivize you to be a repeat partner with us. So
And yeah, and we want to make this process very streamlined. So, typically speaking, and hey, friends, hope you're doing well. Nice, and thank you for coming on the webinar. As far as webinars, that's something that I am spearheading, helping out with. So for our fund managers, I just did a webinar yesterday, actually, with Kishab. That went very nicely. So we're always wanting to accommodate in that regard. As far as PDFs and editable decks. We will provide information and marketing materials so you could do co-branding opportunities with us, which is nothing that is out of the scope possibility. But to your point, and just to hit on a couple more notes there, Rob, with what you just mentioned to answer that question. We understand that a lot of our capital raising partners and fund managers, have full-time jobs, and this is kind of a fun boutique thing for them to do. So we want to make this process as easy for you as possible. And that's one of the upsides to working with a partner like TribeVest is they can really streamline this process for you post fundraising process to make this very easy for you where there's not a lot of ongoing roles and responsibilities. And that kind of gets deferred to them. And then also part of the fees associated with working in that fund structure.
yeah, so once we actually start working together, we'll actually share a bit more in-depth document as far as roles and responsibilities between Lone Star, TribeVest, and the fund to fund, right? There's certain things that we do, like Craig will jump on a webinar with you to help present to your investors. We provide underwriting support. So whatever you choose to go with as far as your fund structure and economic breakdown and whatnot, we can actually plug it into our underwriting model. And actually, we'll today unveil the updates to our underwriting model, which are really slick, if I do say so myself. And we'll show you how you can, on your own, tinker with the model to come up with your own economics and breakdown of that. And then those numbers can then feed into your pitch deck for your investors, right? Because your investors need to know what their returns are. At the end of the day, everyone cares about, hey, what do I get? So hopefully that answers that question. And then I accidentally clicked answer on Marshall's question, but let me actually go ahead and answer it. So Marshall asks, does the model allow investment in more than one property per fund to fund, or is a new fund to fund document required for each property? So that's a good question, and that's perhaps maybe a touch of a gray area, but actually I don't think so. So the nuance there is what you have to avoid is raising a fund that is at your discretion because now you're running into the mutual fund or the Investment Advisory Act. And so whatever properties or investments you want the fund of fund to invest in, they have to be identified from the outset of the PPM and the operating agreement, right? Because for it to be truly a fund of fund, basically it has to be a copy PPM that just says this fund is formed solely for the purpose of investing in this fund. That's it, right? However, you could also go, it's formed solely for the purpose of investing in this fund and this fund. But what you can't do is say, I'm raising a fund and we're going to go and invest in three different deals that we haven't identified yet. That I believe is a bit more of a gray area and requires perhaps different SEC exemptions or registrations.
I have heard of groups, by the way, just to continue that though, with regards to, like a life term or a long-term fund. I don't know the exact terminology the company uses, but that's by Avestor. And I know Avestor has similarly said, hey, you could create like a legacy fund where you kind of keep funds rolling for sponsors like us and I think other groups as well. So they could kind of point you there or give you more information on that. But I have heard of situations like that do exist. So maybe Marshall, that might be a good place for you to look to, potentially solve for that if that's something you're looking to do, or just go through the TribeVest route as we're going through it and are kind of talking about today.
Cool. Very cool. And yeah, Marshall has actually a follow-up question that is the compensation based on how much capital your fund of fund invests? Is this compliant with SEC? So the beauty of the fund of fund structure is that technically we are not compensating the fund manager in any capacity. What we are doing is we are providing enhanced economics to the fund. So just as an example, for the deal that we just closed, which is the Houston 3 property portfolio, where we did do a fund of fund through this structure, our normal deal structure is a 2% acquisition fee, but we actually had a side letter executed which entitled the fund of fund to only pay a 1.5% acquisition fee. So we discount our fee, which is not the same as actually compensating the fund manager for capital raising services, right? So this is SEC compliant because we are not paying the fund manager. Now, however, what that discounted acquisition fee does do is it creates the margin and the room for the fund of fund manager at the fund of fund level to charge their own due diligence fee. So that's what you can call it whatever you like, but we call it a due diligence fee. And actually, we'll actually scroll up to the next section here and kind of get into some of the nitty gritty. But that is that's how the structure works, and that's how it is compliant.
Does it
Okay,
make sense just to go through the presentation and then answer maybe more questions at the end? Because some of these questions may get answered via what you're about to explain.
sure. Yeah, we can make some
Yeah.
progress and then circle back.
And
So,
please keep questions coming. We will get to all of them, we assure you, because this is, the important stuff. This will be redistributed as well. We'll have a recording of this. So we want to make sure that this is out there and easily accessible for you and your friends and anyone else who might be a fund manager. Hopefully, they'll send this their way and would love to do more business with all of you folks on this webinar.
absolutely, yeah. And Craig, if an easy question comes into the Q&A that you just want to answer, feel free to do that as well while I go on. So some of the partnership terms and economics, our stated minimum here for fund to fund partnerships is 1 million. However, there's a lot of familiar faces on this call, and so if we have a existing relationship or we just like you, we are definitely going to be inclined to reduce that minimum. We have partners that we've done many deals with, and oftentimes they come in at a lower number than $1 million minimum. So we definitely want to keep that going. But this is kind of our just to the public minimum 1 million. So, but don't be shy. Reach out to Craig, get in touch with us, and let's definitely work together in 2024 and beyond. And why is there a minimum, or why is the minimum high? That is to number one, uh, scalability. While we do enjoy having many partners, each additional partner is more work. The other important factor are the fixed costs associated with a fund to fund. There's an upfront. If you choose to work with TribeVest and us through our fund to fund program, there is an upfront fee. I believe it's just $5,000, and that is of course a fixed cost. So if you raise 500 grand, that $5,000 weighs more heavily on your net returns to your investors than if you were to raise 5 million, right? Then the fixed costs are almost negligible, essentially negligible. So the higher minimum works in multiple ways and has multiple benefits. One thing I will also mention is it is advantageous to consider partnering with somebody on a fund to fund. And so if you want to work with us on one of our upcoming deals, and let's say you have the confidence to raise 500,000, but not 1 million, And then you have a friend who also raises capital, and you guys both want to raise for the deal. What you could do is you can actually form a joint fund of fund, raise $1 million, and then you're spreading out the fixed costs of the fund of fund across the $1 million fund rather than paying twice for two separate fund of funds. And then you are simply 50-50 partners in that fund of fund, and then you can split the fund manager compensation equally or however you like. So that's a good way
Yeah,
to.
you would own your, respective proportion pro rata, assuming, let's say if you raise 300K and your partner raises 700, you hit the million together, then maybe, you would split the fund to fund costs due to, that being split there to make it more economically viable. And then, accordingly, you can figure out how you want to handle your, equity raised on that end.
Right. So just, I mean, we've kind of been bouncing around, but we'll just cover some of the basics here. So the process would be uh, you, the fund manager, would create a special purpose vehicle that will invest in our deal. The deal will either have specially designated Class C shares designed for fund of funds, or we'll simply do a side letter. I actually, we've gone back and forth on whether we want to have that dedicated class baked into the operating agreement or if we just want to do side letters. It's the same thing functionally. It doesn't matter in my opinion. Typical terms that we are offering for fund of funds is first, as I mentioned, the reduced acquisition fee from 2% to 1.5%. And again, the fund of fund manager can then charge whatever they like, but that 0.5% spread creates room for the fund of fund manager to charge a fee at their fund level. Then we offer enhanced waterfall. So it's a 9% preferred return, which is superior to the 8% that we offer our Class A investors. And then it's a very attractive 20% promote. So an 80-20 split, 80% to the fund of fund and 20% to us, the sponsor, for our promote, instead of our typical 30% promote over an 8 pref with a 50-50 promote over a 50-50 split over 15% IRR. So this is not set in stone. This is certainly deal by deal because some deals just have different economics. They might be projecting higher returns. There's more opportunity to share, or if it's tighter and there's less of an opportunity to provide a discounted fee structure, etc. So, but that's general guidelines. And of course, we'll provide a separate underwriting file specifically for fund of funds, which we will actually share on screen shortly for every deal. So when you're considering working with us on a deal, you can take a look at the fund of fund underwriting and look at, okay, what are the terms to the fund of fund? What are the recommended terms that I charge at my fund of fund level? And then what does that mean for me as far as my compensation in terms of upfront compensation through my due diligence fee, as well as my back end compensation through my promote. And then if you want to have an asset management fee, you can do that. We discourage it because it's going to create a discrepancy or a big difference between your LP's cash on cash return and the direct deal cash on cash return, right? We want to minimize discrepancies as much as possible. So
It is a way to solve for, getting paid in the middle. We spoke with one capital raising partner, fund manager, said he wants to get paid his in ideal world, beginning, middle, and end, which is understandable, but it's going to come from somewhere naturally.
right. So yeah, hopefully that all makes sense, and we'll share the numbers, which I think will make a lot more sense shortly. So again, we're not forcing anything upon you, but we do have a recommended SPV structure. So the way that we and that recommended structure will be different for every deal. But what we're trying to do is solve for at least a 10% compensation to the fund of fund manager on their equity raise. So if a fund of fund manager raises $1 million, we want to put together a recommended structure that they will target making 10% plus on that million. So 100K plus on $1 million raise over a 5-year projected hold period. And we'll
which
actually show
is
that in the numbers.
which is very similar, as we alluded to earlier, to the co-GP model and structure. You're looking to solve for that, 10 plus range on your raise.
Yep. And, just a quick shout out. We are pretty confident in the opportunities coming in 2024. We think it's going to be a fantastic year to buy real estate. And we've modeled out some of the deals that are in our pipeline and the the manager compensation, because the deals are projected to look so attractive, there's more room to share in that upside with fund of fund managers where that 10% is, 12, 13, very attractive. So yeah, definitely an exciting time to be rolling this out. So just as an example, you as the fund of fund manager can charge a 2% due diligence fee, and that will be paid at closing. And that's kind of similar to if you were sharing in our acquisition fee. But again, it's different, and that's what makes it a compliant. And then the costs for setup, such as legal and accounting and things like that, those are baked into your SPV as well. So, and we have that shown in the model. So your fund to fund bears those costs, which then are effectively paid for by your investors, which is reflected in their net return. So we need to make sure that your fund to fund is being compensated with a strong enough enhanced terms, so that they can cover those costs and your LPs can still get a great return. And here you can see at the fund to fund level, you also will have a preferred return that you'll owe to your investors. And then we recommend here, just as an example, charging a 12.5% promote, but it can be different on the deal. It could be 10, it could be 12.5. If you want to make more money, you can charge 15. It just depends, and we'll toggle with all that in a second. Like I keeps hyping it up. So this is an example before we go to a real life example, but this is just a hypothetical example based on a real deal that we looked at. So if an investor were to come off the street and invest $50,000 directly into our offering, these are the projected returns. 16.2% IRR, or a 20% average annual return, 7.2% cash on cash, and a 2x equity multiple. Now, with the above recommended compensation and recommended structure of a 2% due diligence fee, 8 pref, and a 12.5% promote, coupled with the enhanced economics flowing to your fund to fund, the LPs of your fund to fund are projected to earn a comparable, slightly better even, 16.3% IRR, or a 20.2% average annual return, a slightly worse cash on cash, 6.9% versus 7.2%. And that again comes from the drag of the fixed costs associated with the fund to fund. And then a 2.01x equity multiple, which is, roughly in line with the total return. And again, in this scenario, the fund to fund manager will earn a 2% due diligence fee of $20,000 on their $1 million fund to fund. And the promote here is underwritten to be worth about $85,000. So in total, you're looking at just shy of 10.5% compensation on your equity raised as the fund to fund manager. I'm going to take a pause here and look at some questions. Hopefully that answered some of them. I know Mitten asked about the minimum investment amount for the fund to fund vehicle. So yeah, I mean, it's a stated minimum of $1 million, but we think that the lowest that anyone should be willing to go really is 500,000, because below that, you really starts to, the fixed costs really do drag on the returns.
Yeah, and listen, you can technically, if you'd like, raise and set up a fund to pull money together sub 500K. But as we just kind of broke out here, the costs associated with that do start to add up, making it less, not the most economically viable for you. But we're never going to discourage potentially a new partner who's up and coming. But it does logically make more sense at that point to potentially partner with someone else and maybe create that fund together. And we can kind of help with that situation if we have got multiple people who are flexible to it. So we want to get creative and thrifty, if you will, to make sure that everyone can kind of work with us. The big goal is to scale up our capital partners and, do it in a safe way. And we feel as if this is the route to do it.
Absolutely. Shan asks about the 5K fixed costs. So those fixed costs are for each fund to fund formation, and a fund to fund will need to be formed per opportunity. So if we're doing a deal together in January and then we're doing another deal together in April, those will be separate SPVs that are formed, and the 5K will be applied to those two opportunities separately. Let's just go back a little bit in time here. So Whitney asks, not sure if you will discuss later, but can you elaborate more on the expectations of your reporting frequency and auditing? So we don't do any auditing in our business. We don't have audited financials in our business, but we do send out monthly financials, monthly updates, and quarterly reports and monthly distributions.
And if you want to go a step further, would like to look at our entire data room, our portfolio, I have a Word document with every link to every deal that we're managing currently. I would be more than happy to share that information with you.
Yeah. So we maintain an investor Dropbox for every deal in our portfolio and for sold deals, which includes the original data room for the acquisition, which has the pitch deck, the underwriting, the financials, everything. And then also in that data room are the monthly financials and the quarterly reports for that deal. So you can see a deal from the upfront inception of it, the acquisition data room, and then through the quarterly reports through the life of the deal. So that's a great way to do due diligence on us and see the good, the bad, and the ugly, and see how we've managed the wins and also handled difficult situations. So we have that transparently available for every single deal in our portfolio. And while we're on that topic of reports and everything, we do feel we put in a ton of effort on monthly and quarterly reports, and we do think that it is best in class. Franklin asks, my understanding is that TribeVest fund structure is organized as an LLC and gets around forming a Reg D fund relying on all investors being active as an investment club. Is this the case with these fund of funds? I don't believe so. I believe the fund of fund is still a Reg D 506B or 506C offering with its own PPM and subscription agreement. So I don't think it's quite the same situation there. Brent asks, what's the benefit to the investor to go fund to fund? So to clarify that question, I'm not sure if Brent is referring to what is the benefit of the LP of the fund to fund to go to be an LP of the fund to fund or be a direct LP, uh, because that can be answered in a few ways. As we've discussed, perhaps it could be structured so that there's enhanced terms and returns to the fund to fund LP rather than investing directly. There could be a lower minimum for the fund to fund. So, our minimum is already quite accessible at 50,000, but a fund to fund partner could set up their fund and they could charge whatever minimum they want. They could have a $5,000 minimum if they want, and that could be a benefit to the investor to go to the fund to fund rather than investing with us directly, which would be prohibitive for a 5K investor, right? We wouldn't allow that. Now, as far as what's the benefit to the fund manager or to a capital raising partner to go fund to fund, we talked about this at the beginning. The benefits are SEC compliance, control over your economics, and control over your investors. All right. Mono says, is the fixed cost of 5K upfront and 2K ongoing paid to TribeVest to cover legal and accounting? Yes, it is. Okay, awesome. That was great. Great questions. We're rolling
Please
right
keep them
along.
coming.
Yep. Okay, so we've definitely touched on some of these features, but let's just go over roles and responsibilities here. So on the marketing and sales side, this is the fun stuff. So like we said, we will provide the fund to fund underwriting, which has the return calculations and the structure and the recommended structure and things like that. We also will provide our pitch deck for the deal in PowerPoint. So you can edit it to however you like, and you can add your logo, you can change things. You will, of course, need to change the certain information related to the returns, right? Because the returns very well may be different as far as the annual cash flow projections, the IRR, the equity multiple, and the waterfall, right? Because your investors will be investing into your fund of fund, which is not going to have just a simple waterfall, right? Unfortunately, there is some complexity here where your LPs are investing in what is referred to as a double promote structure, right? Because your fund to fund is subject to our parent promote, and then your LPs are subject to the fund to fund level promote. So there's waterfall number one, waterfall number two, then they make their money or then they get their returns. So that's a bit more complicated. And so we've seen fund to fund managers kind of not really put this front and center in their pitch decks because for most investors that is quite confusing, and it's not really helpful to them to understand. So it's more important, more beneficial to put front and center the projected returns to them, and then kind of explain in an appendix or in a different capacity. We're still this is still very much so a work in progress, and so as we do more deals with you all, we'll certainly come up with best practices, and we'll update this document to make sure we're sharing the best practices across the industry and across all our partners, so that we can all be as successful as possible together in raising capital and doing good deals. So we will, like I said, provide the PowerPoint pitch deck, and you can edit that to create your own. Uh, we will provide our webinar. So, Craig, you want to cover some of the things that our partners do with our webinar as far as either recording their own or just recording a little intro and then attaching ours and all that good stuff?
Yeah, there's several ways to handle that process. Everyone can do it how they feel is best. I've worked with some people before where we just do a little kind of fireside kind of chat, a couple Q&A, or maybe just a couple minute, monologue introduction of who they are, and or what they're providing, and then they'll kind of tie me into it and have me do a high level overview of the deal. So that is one solution that could be 5 to 10 minutes, and then that could cut right into our webinar. The other solution would be for the fund manager to directly do a webinar with myself. We would kind of set up a call and go through that together. And we would kind of go through what points to hit, and we can kind of walk through how that could be most effective prior to the date of the webinar. And on that, when people do it that way, what typically happens is that they'll insert, their branding synonymous with Lone Star, and then we'll, add themselves as the team section into it. In addition to that, if one is to work with us, we do have an onboarding process. Dasha Beardsley, Rob's sister, the director of investor relations, will happily onboard you. And then before you send out any marketing materials or information, we have to greenlight it to make sure that our numbers are cohesive and coherent, and are all together and line up, so there's not multiple different numbers being sent out for obvious reasons. But that's kind of a little bit of the onboarding process, how it is working with us. It's a very streamlined and simple process. We want to make this easy for you as possible. And, our goal is to give all of our capital partners ideally 45 to 60 days to hit their committed tranche level for their fund allotment.
Beautiful. Okay, so moving on to the data room, as we do with all of our investors, we provide a data room for our acquisitions, which include the property historical financials, our underwriting, our pitch deck, and other due diligence. So that will all be provided, which you can then take and put together your own data room, or whatever it is that you do to share due diligence to your investors. You could pass it along however you want, but we will certainly provide it to you from the outset. And so we use AppFolio as our investor portal. And so you may have your own portal, or you may not have a portal, but all that you will need to do is, as the manager of the fund of fund, you will utilize AppFolio to make the investment. So you'll be subscribing the fund of fund and investing on behalf of the fund of fund into the parent offering through AppFolio. And then in AppFolio, you'll be able to track the fund of fund's investment position, the monthly distributions, documents, and tax files, and things like that, right? So yeah, it's all pretty straightforward. Nothing too crazy there. And TribeVest is working on making some updates. Like here we have a note about a landing page. So TribeVest is working on rolling out a landing page where you could then utilize a URL to direct your investors to, and that'll be a way to collect soft commitments. For now, TribeVest can provide you just a simple Google form that they put together, and that can be used as your soft commitment form to collect your LP commitments. And then they'll help with you on that process of actually getting your commitments from soft to signed and funded.
So real quick, just to make this clear, if one were to use TriVest or any fund-to-fund process, are they directly investing? Do the investors go on like the old model, like we've done before, directly into our site, or do they go to TriVest or whatever respective platform and then invest directly from there with one check into us. Can you just maybe talk about that real quick?
Yeah, so the LPs of the fund manager will utilize TribeVest's soft commitment form and then work with the fund of fund manager and TribeVest to sign the subscription agreement and fund the bank account that TribeVest will open. And then once all commitments are collected into that fund to fund account, then in bulk those funds will be wired to the main deal. And that is as part of the process of the fund to fund manager actually signing, let's say they'll actually go into Appfolio and say, okay, I'm investing in this Lone Star offering and I'm committing for 1 million and I'm going to wire the money through this account and sign the subscription done, right? So that's it's really quite simple. Okay, so real quick, I'll answer some questions and then we'll get finished. I do still want to leave some time to show the underwriting spreadsheet. Okay, so Randy says you mentioned TribeVest prepares K1s, but do they create monthly financial statements, income statement, balance sheet, cash flow statements? No, we would be providing those as our we have in-house accounting. We will provide accounting for the property level income statement, balance sheet, cash flow statements, etc., and the property performance. Uh, Randy Smith asks, should we input and estimate how much we'll raise in the soft commit or just wait until we finalize the raise to do the soft commit? So the Lone Star doesn't have a formal fund to fund soft commit formal, as far as like a document, but we certainly will work with you and our fund manager partners at the beginning of a deal and say, okay, here's the deal. Okay, you like the deal. Sounds good. You feel confident in raising X. Okay, great. We'll put you down for X. So that's just really a conversation to have. And we might say, you know what? We have other investors that we want to leave room for. Can you actually do this amount or something like that? But yeah, we we will kind of informally accept a soft commit. We'll put it down in our system, but it's not anything that you'll have to actually input in a form or an Appfolio or anything like that.
Yeah, so this should actually really solve and make the tracking process easier on our end and ideally on your end as well. And much like, similar or other structures and setups, these are fluid situations in a raising process. We understand there are opportunities where someone ends up with $1 million in their pocket that they have to invest and you totally run through your goals. And we understand that there's sometimes, you just came out of a raise or, the market or the deal is not boasting the outcome that you would like. So these are fluid processes. We understand that it's not a 100% precise exercise, but just like we've been doing before with you, Randy, just keep dialogue going and communicating, and we'll get through it and act accordingly on our end or on your end.
Yeah, and also I just want to add maybe a little bit more color going back to other Randy Langendorfer's question as far as K1s and monthly financials, right? So on a monthly basis, we will send the fund's distribution, and let's just say it's $10,000. So we send $10,000 to the fund, and then TribeVest, in partnership with you, the fund manager, I mean, I say in partnership loosely, they'll handle all this, but you'll certainly be abreast and oversee this. They'll take that bulk $10,000 distribution to the fund to fund, and then they'll pro rata allocate it across the underlying LPs. Let's say there's 10 LPs that each invested 100K in that $1 million fund to fund, right? They'll take that $10,000 distribution and then chop it up and send it out. So that's all handled for you, which I think is basically kind of what we talk about here in the remaining portion of the document. We've covered all this. A big thing is blue sky filings. Blue sky filings aren't cheap and they aren't easy or quick to do, right? So it really is a fantastic thing that TribeVest provides this service where they're doing the LLC formation, compliance, forming the PPM, subscription agreement, operating agreement, and the blue sky filings. And then of course opening the bank account, not hard to do, but it's just nice that they have all that put together for us and then manage your cap table as your investors are signing and funding.
And as a salesperson, I'm sure all of you people who are capital raisers are salespeople ultimately can appreciate just the streamlined process of here. I know when I get an idea, I'm excited to run with it, not think about the tedious back end processes associated with, raising the money and putting the structures and systems in place. So we hope this is a way to expedite that process. And to help you focus on the most important part, which is bringing in the equity and securing the capital directly into the investment.
Beautiful. Okay, I think that pretty much covers the high level. So what I'm going to do is now share my screen and we're going to do
Could you do the Houston three property portfolio? As there
yes.
could be some potential fund managers here who are on the fence about maybe bringing in a little bit of equity to that opportunity. And then also, I just want to shout out Jeremy Dyer. If you're still on here, you had a couple of questions that I thought were important that I would really love to have be answered because I don't think you're the only one that would think about a question like this. So either I could pull up in the email, or if you want to throw it back into the chat, we can kind of get that answer and solve for as we speak and live on air.
Did we miss this question?
No, this was an email question
Oh,
that he sent
got
over to me. So what I could
it.
do is just maybe pull it up real quick.
Mailbag. Got it.
Hmm.
Very good. Okay, excellent. So, for some of you, this is familiar, but for those that it's not, this is our underwriting spreadsheet. Nothing too special. Everyone has one. So the thing that is special though and new is the addition of the built-in fund-to-fund calculation capabilities. So, firstly, this is the base, uh, simple underwriting model, and this just has the base Class A terms, right? So you'll see the 2% acquisition fee, the 8% pref, 30% promote, and this results in a 15.8% projected IRR, 6.1% projected cash on cash, and so on, right? So that sets the stage for just the base economics of the Houston three property portfolio, which, as Craig mentioned, we just closed a couple weeks ago. But we actually, believe it or not, in this environment raised a whopping, I believe, about 36 million, but we do have about 2 million remaining. So we are looking to close that gap. So I think we're speaking with a couple more partners to do that. So if you are interested, please get in touch with Craig and we can have a further conversation on that. So that's that sets the stage for the Class A economics and the model here for this opportunity. Now I'm going to flip over to the specific fund-to-fund model. Bang. Okay. I know it looks exactly the same. So, and that's kind of the point. So, but now what you see is the returns are higher. And why is that? Well, that's because these are the returns actually projected to the fund to fund. Right. So these are the gross returns to the fund. And then we'll actually deal with in a second the net returns to the fund to fund LP. So the way that that is taken care of is actually on the waterfall tab. So we head to the waterfall tab. And one thing that's important is in order for the features and the calculations to work correctly, you have to set the sponsor equity contribution to 0. That way the spreadsheet doesn't conflate equity, how do I say that? Capital returns versus promote for the sponsor, right? We want to make sure that that's just not getting confused. So we just set that to 0 and that works all correctly. So here you see the offer that the structure that we offer to fund partners in this deal, which is a 20% promote over a 9% preferred return. That's here. And that's why predominantly between that and the discounted acquisition fee is why you see these returns being superior to the baseline returns that you see here, right? And as I mentioned, that creates the space to then charge fees and bear the costs of the fund of fund. So, and I do apologize, this is a slightly more complicated waterfall because this is a very unique deal in partnership with the Houston Housing Authority, whereby they have a participation or their own separate waterfall, believe it or not. So there's a ton of waterfalls happening in this deal, but it's all for the best because it results in a 99-year, 100% property tax exemption, which makes these deals very unique and attractive. So can ignore all that. The important point is the fund to fund section here. And so this is a very exciting, I didn't catch all of it, but this is a very exciting new piece of tech in our model that we're very excited to be to have and share with you. So what you see in blue is editable on your end. So if you only plan on raising a $750,000 fund, go ahead and put it in there. If you're raising $1 million fund, go ahead and put it in there. Uh, this needs to be called a DD fee. That's what we've decided to name it, due diligence fee. So this is the fee that you will charge to your LPs at the fund level, right? Like we talked about in the example, you charge 2% on your fund. Again, we're not paying you this 2%. You are charging this 2% from your fund. And then here we have the recommended promote structure, just as it was in the document, which is a 12.5% promote over an 8 pref. And that is at your fund to fund level. So let me walk through how this waterfall works. So firstly, you have your fees. And actually, I now that I'm seeing this, this is not updated because this needs to have
Well, it's
this.
so perfect. You can walk us through this great information in real time to really show that you're the expert.
Yeah, this is terrible. So anyway, you have your fixed costs of the fund to fund here, which are the one-time setup and then the ongoing accounting and legal stuff, K1s. And then this results in your net fees or net return before the waterfall. And then, of course, you flow these returns through the waterfall, which is you, the fund manager, get 12.5% over an 8% preferred return. And that leaves you with your promote and your, yeah, so it really just calculates your promote. All this fancy stuff here is just to calculate your promote. And here in the end, you see the fund to fund LP IRR is calculated, and it results in a 15.9% IRR and a 1.98% equity multiple. And that's very similar to the returns here, right? It's actually a 1.98% equity multiple in both scenarios, right? But the IRR is just slightly different, 15.8 versus 15.9. And
And as
again,
you can see, I think the important number to look at is what's your total comp? We're incentivized creatures. If you go to the fund of FOF manager compensation, which is 160D, I believe you can see what your precise amount would be following a successful deal and raise.
exactly. So you have your $20,000 due diligence fee up front, and then you have your projected promote on the back end here. And that results in $100,000 on $1 million raise, which is almost 10% on the dot, which we're again striving for 10% plus. But this falls into that category. So yeah, I apologize for having some errors. I see this cash on cash is not right. We'll get all that fixed. We have an updated spreadsheet. This is just an older one. But yeah, that is in essence the feature. So for every deal, we will share with you this document and with the fund to fund structure that we're offering for that particular deal. Because again, it's not always going to be a 20 over 9. And then it is at your discretion to input your numbers, your anticipated raise amount. If you want to maybe charge a 1.5% fee, or maybe you want to charge a 3% fee, right? You're welcome to do that on your end there as well.
Could you also show maybe different economics real quick and how people can kind of play with the inputs so they can get more familiar with that? With regards to maybe, giving someone a 9 pref or, a 9 pref, but a lower, hurdle for the waterfall on the back end, maybe something slightly different so people can get an understanding of it.
Yeah, sure. So like I said, you can play with it. So, perhaps you want to charge a higher upfront fee, like you just really want a 3% fee upfront rather than 2. And in exchange, perhaps you're willing to give your investors a better, you give them a 9 pref and you only charge a 10% promote, right? So that's going to, let's see what that results in. So as you can see, it results in a 15.9 IRR, which is actually identical to what it was in the previous structure. Just a tick higher in the equity multiple. Uh, the cash on cash is going to be a little bit worse because of the upfront fee being a drag on returns. But yeah, that's just one of the many ways to play with it. You
But
can,
you can see on the compensation side where that money will come from and out of your pocket. It's
yes,
8 point that's 1.4% higher to your set investor right there. on your allotment for that $1 million, should you elect to structure your fund in that regard. So it is cool that you can kind of charge a different fee and set it up accordingly. And maybe you'll have different tiers for your investors. That's something for you to figure out. Rob, so I couldn't put in a question based off Jeremy's question in the Q&A section as I'm a panelist, but I did put it in the chat. Do you mind kind of just going through that and maybe showing what that could look like if we have the capability to do so?
Yeah, sure. Yeah, and thanks for pointing out also just this conclusion here, this insight, right? You were able to charge a higher fee, but then give up on your promote, which still gave your investors a comparable return. But again, in the end, in total, the fund manager made less money, but also they made more money up front, right? So time value of money, maybe they made more. So it really depends on what your priorities are, what you want to do with your investors, et cetera. That's why we talked about from the very beginning. This is more customizable. You're more in control of your destiny and your compensation here. So I know this was a fast rundown of how this spreadsheet works. This is not going to be the last time you'll see it. You'll see it from us every deal. And so you'll become an expert in no time. And we're happy to walk through it with you as well, as we're all working on it together. So I will get to the question, Craig, that you put in the chat. But first, I'm going to answer Flint's question. He says, I haven't used TribeVest before. Can we use our existing portal but utilize TribeVest services for legal, taxes, Blue Sky, etc.? Yes, absolutely. So you can use your own portal, but then still take advantage of TribeVest's turnkey solution on the legal, tax, Blue Sky, bank account, funding, distributions, everything. Okay. All right. So I know we're at the hour, so we want to be conscientious of your time. I actually have a call myself. So we'll breeze through this question, and whatever we weren't able to cover, please feel free to reach out to us, and we're happy to continue the conversation. But real quick, question came in, I believe, Craig, like you said, from Jeremy. What is the pref and sponsor split to the Capital Partners Fund? Okay, I think this is just everything that we've already covered. So we're not going to get into all that. We've already covered it.
Well,
Uh,
there's also an example below.
okay, for example,
Giving,
one sponsor we
yeah.
work with provides our SPV fund with an 8 pref and 90-10 split with no additional waterfall. From there, our SPV fund provides LP investor with a 7 pref and 85-15 split with no additional waterfall. We also factor in legal, back office, and accounting fees into the fund level costs. The acquisition fee we charge in the fund is 2%, and we target a 12 to 14% total fund level compensation, including the acquisition fee. Okay, that's all great. That's a good example. So he's already familiar with these sorts of double promote structures and everything like that. We will not do a 90-10 split. That's just, that is selling ourselves short. But that's if someone else is offering that, then that's great. So anyway, thanks everyone for being on. Hope you enjoyed and got a lot out of this, and hope this was helpful in giving you the confidence to learn more and proceed in this new industry trend together on the fund to fund structure.
Once more, I've put in my email, my phone number, as well as my Calendly link if you want to set up an appointment with me. As mentioned, we have just a little bit of space left in the Houston 3 property portfolio where you just saw the example economics should you want to raise for that opportunity. We really appreciate all the partners who came on here, a lot of familiar faces and a lot of new faces. So it's great to see a mix of both. We are actively looking for, growing our pool of partners. We're really excited what we've been able to accomplish to this point at Lone Star, but we're looking to expansively grow. We have a lot of fun deals that we're kind of seeing in the pipeline that aren't ready to go live yet. But we do think that 2024 will have a really robust and exciting pipeline to share with everyone. But of course, looking to close out this 3 property portfolio. So until that's done, we're not going to launch anything, but very excited to hopefully work with some of the new faces here and continue growing relationships with those who we've worked with in the past.
Excellent. Good stuff. All right. Thanks, everybody. Talk to you soon.